You pay attention in school, study hard, land a decent job, and work steadily through your career, all with the hope of one day relaxing and enjoying a peaceful retirement. That's the narrative, but it doesn't always match reality. There are countless stories of people with respectable jobs and consistent savings habits who still find themselves working into their old age. This doesn't even touch on those who never had the chance for higher education or a stable career. Recent reports suggest that less than 30% of American workers are on track to retire at all, with even fewer expecting a comfortable retirement. I know this might be tough to hear, but several significant factors today are keeping many young people in the workforce indefinitely. This is even before considering the massive disruption caused by the COVID-19 pandemic, which has further widened the financial gap between the younger generation with fewer assets and less stable jobs, and the older generation, which tends to be more financially secure. You might think you're an exception. You contribute to your 401k, save conscientiously, and invest in the stock market. That's commendable, but there might still be some concerning news for you. Several issues, including housing, the stock market, and broader economic conditions, might threaten the usual assumptions about continuous growth. Let's start with housing. For most workers in the USA, affording a home has become a major challenge. Even high earners from top universities, working in sectors like investment banking or big tech, often move to areas with high living costs, like New York, Chicago, or San Francisco. The average age for buying a first home in 2019 was 34, with young buyers often opting for smaller apartments or townhouses instead of traditional family homes, not out of preference but due to affordability. This is a crucial point, as owning a home can lead to financial security. It eliminates rent expenses, and mortgage payments build equity. Once the mortgage is paid off, you have a place to live with minimal ongoing costs, making retirement savings or pensions stretch further, especially compared to those needing to cover rent. However, if we take the median age of 34 for a first home purchase and add a 30-year mortgage, even this optimistic scenario puts a regular young worker in their mid-60s before paying off their home loan. This assumes no upgrades or renovations that would increase the mortgage. The situation is complicated further by the housing affordability crisis, which not only pushes up real estate prices, but also diverts investments from productive assets that could sustain retirement. The inflation of all asset markets adds another layer of complexity. For example, consider shares as money-making machines through dividends. If the price of shares increases significantly while dividends remain constant, it becomes increasingly difficult for an average worker to accumulate enough assets to fund retirement. This isn't just a hypothetical scenario, it mirrors current market conditions. The price-to-earnings ratio of the S&P 500, historically around 15, is now around 50, the second highest in history. Although dividends might increase, it's unlikely we'll see widespread PE ratios under 20 again, due to market dynamics and corporate strategies. Furthermore, leading economists like Robert J. Gordon have raised concerns about future economic growth. In his paper, Is the U.S. Economy Growth Over?, Gordon argues that the last 200 years of innovation and economic growth were more of an anomaly than a norm we can expect to continue forever. Think about it. Can we really expect endless growth in a world with limited resources? Gordon points out that all the groundbreaking innovations that significantly boosted productivity have already been discovered. From now on, making even small improvements will likely be costly or just about rearranging existing values rather than creating new ones. Gordon presents a pretty gloomy view, suggesting that we're facing what he calls 6 economic headwinds that could slow down global economic growth for at least the next century. First, there's the loss of the demographic dividend. The economy got a big boost when women started joining the workforce from the 1960s to the 1990s. But now that's just normal, and we can't double the workforce again, unless we push people to work into their old age. Second is the decline in educational attainment, especially in the US. Education's getting pricier, less effective, and often doesn't meet the modern workforce's needs. A college degree just doesn't hold the same value it did 50 years ago, both for individuals and the economy. Third, we're dealing with rising inequality. It's a sensitive topic, but Gordon tackles it pragmatically. He notes that while average incomes are growing by about 1.3% yearly, this increase is mostly seen in the top 1%. The rest barely see any growth, not enough to keep up with inflation. This means if this trend continues, more and more workers won't be able to save enough for retirement. The fifth headwind is about energy and the environment. Our past century's growth was fueled by fossil fuels, efficient but finite and costly in terms of environmental impact. Now, younger generations are paying the price, either through environmental regulations that hinder industrial output or potential environmental disasters that could halt production. The last headwind is the ever-increasing debt, household, government, corporate. It's been rising steadily, and eventually it has to be paid back. This means governments might raise taxes, while individuals and businesses might have to cut back on spending. If you're already on a tight budget, you might find yourself cutting back on retirement savings. Gordon does suggest a possible solution for these challenges. You can probably guess what it is. Yep, raising the retirement age. So if you're still optimistic about making millions overnight, more power to you. I might just have to try harder next time to bring you back to reality. So that's it for today. If you found this video informative, please like, subscribe, and share. And don't forget to stay informed and engaged with updates on finance, business, and technology.